On paper, the data says that America's economy is booming. GDP is up, unemployment is down, and the S&P 500 is still near record highs. But if you talk to anyone outside of the top 20% in society, they'll tell you something different.
Every day, most of us wake up and go to a job that we really don't like, but we can't really quit because we got to get the money to pay the bills that they say is important to pay. What the fuck is the point of this life, man? We go to grocery stores and buy food that God gave us for free.
It doesn't feel like a boom. It feels like the trenches. Most people are struggling to even exist.
I have been financially not doing great. Even though I am a nurse and I make good money, I don't have money.
Groceries cost more, rent eats half of the paycheck, and now savings means not using the credit card this week. But how are these two things happening at the same time? How can the economy be rich when so many people feel poor? Welcome to the K-shaped recovery, where asset prices climb while paychecks fall behind. After every crisis, charts form letters. You've got the V shape, the U shape, and even the W shape. These are all patterns for recoveries on charts. But the last 5 years have traced a new letter, a K. Two recoveries moving in opposite directions, one up, one down. On the upper arm, stockholders, homeowners, corporations. On the lower, wage earners, renters, and small businesses. According to PBS News, the top 10% now drive half of all consumer spending in America. Meanwhile, median households are cutting essentials just to stay afloat. This isn't broad-based growth, it's concentrated prosperity, a recovery so uneven that for most Americans, the boom just feels like someone else's headline. The K-shaped recovery didn't just happen by accident. It's the product of a system built to protect markets first and leave everything else second. When COVID hit, Washington unleashed their full fiscal firepower. Stimulus checks, PPP loans, corporate bailouts, and 0% interest rates. At first, everyone benefited. Cash flooded households, the stock market was booming, and crypto was the future. Course sellers were all buying Lamborghinis, and everyone on Twitter was making $100K a year. Or so they say. But by 2022, the side effects emerged. Asset prices kept climbing, but so did the price of everything else, especially everyday goods. We've now entered an era known as Paradigm C, and in my last video, we went over this, so check it out when you get the chance. The link will be in the description below. Before a quick recap, we're currently in fiscal dominance 2.0. This is an era where government spending and Federal Reserve policy move hand in hand, prioritizing growth and stability of the top 10% at any cost. It's not classic free market capitalism, it's state-directed capitalism, or simply put, it's just corporate socialism. Rate cuts and balance sheet policy of the Fed tend to add liquidity into the markets, and liquidity tends to lift asset prices first. Despite what Fed Chair Jerome Powell has to say about that.
And could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles?
Big U.S. companies are just investing a lot of resources in thinking about how AI is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
Meanwhile, in the real economy, the people that live off wages pay the ultimate price through persistent inflation.
Our economy is either going to collapse in the next 6 to 8 months or we're going to print trillions of dollars into our economy.
DoorDash, Wendy's, Chipotle, Norwegian Cruises all collapsed this week after horrible earnings. The average American has no money left to spend on anything.
The same liquidity that props up markets quietly destroys purchasing power for the average person. The government can't tax its way out of record debt. It can't cut its way out either. So instead, it inflates its way out, slowly, deliberately, and permanently. The mechanics are simple. The Federal Reserve cuts rates, money becomes cheap, Investors borrow to buy assets such as stocks, homes, crypto, and other companies, but the real wages don't move the same way. Labor markets always adjust slowly. Right now, hiring has slowed down as the corporate overlords try to replace human workers with AI. Regardless if this is working or not, it doesn't matter. This is because it's contributing to the slowed growth in both job availability and real wages. Meanwhile, the return on capital continues to compound while the return on wages continues to stagnate. It's been like this for the last 25 years. As asset prices continue to inflate, the top 20% ends up spending more into the economy because they just simply have more money. This is called the wealth effect. This happens when higher asset values make the wealthy spend even more, which ends up boosting GDP for the country. However, keep in mind that GDP tracks economic activity, not the financial strain of the average household. GDP can rise while the average household is worse off. That's being reflected in both the data and anecdotally in real life.
Bro, if I knew how bad the economy was going to be up to date, I wouldn't have been riding no bikes, playing no video games. I would have bought a house when I was 10.
Right now in Canada and the United States, food bank visits are reaching all-time highs. But at the same time, World Series tickets were selling for $1,300 for nosebleeds in both Toronto and LA. Luxury brand retailers like Aritzia are up 110% on the year. Real wages are still below their 2019 peak, and the average credit card interest rate has climbed past 21%. Household savings that were once peaking during the stimulus era are now nearly gone. Keeping real interest rates below the rate of inflation quietly transfers purchasing power from savers to borrowers, and more importantly, from income earners on Main Street to asset owners on Wall Street. Every percentage point of inflation above wage growth is a hidden tax, a tax that compounds faster than any stock, bond, or dividend. For the top 20%, life is steady, extremely good. Luxury travel bookings are up 38% year over year, and the high-end real estate market is still relatively sold out. The liquidity is still there, and most importantly, portfolios keep rising. But below that line, life is pure hell. Rent takes up 35 to 40% of income on average. Food inflation runs twice the official CPI. And families who once paid off credit cards monthly now carry balances just to afford the basics. A recent study came out and revealed that 25% of Americans say they'll never own a home, and 50% can't even cover a $1,000 emergency. Economists may describe this as the resilient consumer.
Still resilient consumer.
The consumer remains resilient.
The consumer is resilient.
But that resilience isn't reflected in the average household. It's not consumer confidence. It's more like consumer exhaustion. There are some people who are working 2 to 3 jobs just to survive life in most North American cities.
I have 3 jobs and I'm still struggling. I have 1 full-time job with full benefits and then 2 part-time/contract jobs, and I am still struggling.
The bottom half of the K isn't lazy, it's overworked and it's over leveraged. People aren't choosing Netflix or Starbucks over savings. They're choosing groceries over mortgages and rent. Headlines may celebrate the strong consumer spending, but we must keep in mind that statistics often become a warning. It's not a win as the mainstream news might suggest. The upper arm of the K now runs on a different kind of fuel. It runs off speculation and inflation blended together. In 2025, corporate investment in AI and data centers accounted for 92% of GDP growth in the United States. This is despite the fact that 95% of organizations are failing at their generative AI investments, according to AI researchers at MIT. These new digital factories consume more power than we could even imagine. According to CNBC, a gigawatt-sized data center uses so much electricity that it's comparable to a city of more than 800,000 people. That's about the population of San Francisco proper. Even at the lower peak demand pricing, it drives electricity costs higher for everyone else. The AI boom may look like progress, and in many ways it is, but it's also another wealth concentrator. Some economists are even calling this a concentration bubble.
So I've said for the last year and a half that we're in a concentration bubble, which is a different kind of bubble than the way people tend to think about what bubbles are. Concentration bubble gets bursts in one of 2 ways. Either the largest names break down heavily, or there's breadth that improves and everything else catches up, right? The way to play it is just not to be in where everybody else is, which is what has been working, right? Which is in the NVIDIAs and AI plays of the world.
A handful of companies almost capture nearly all of the productivity gains, while workers see very little upside from it. For investors, it's like an asset supercycle, but for consumers, it's another bill in the sea of rising living expenses. Every generation thinks its crisis is unique, but one thing remains true. Inequality always accelerates during recoveries and not recessions. Sounds like a contradiction, I know, but let me explain. The opportunity comes from the recession or the depression itself, ultimately creating a wider wealth gap. In 2008, firms like Blackstone bought tens of thousands of foreclosed homes, becoming America's largest landlord. In 2020, the same pattern returned. Reckless stimulus flowed into markets, but also record debt weighed on households. Today, corporate cash reserves, also known as economic dry powder, sit at an all-time high waiting for the next discount on a crisis. In the meantime, debt of the average household continues to compound in areas like car loans and credit cards. This is reflected in the data, which shows us that delinquencies are now on the rise.
So what we saw was that Q1 of this year, actually auto loans became the riskiest consumer credit product. And that has been something that has been evolving over some time. Going back to the first quarter of 2010, at that point, auto loans were actually the least riskiable consumer loan product.
Each intervention by the Fed makes the next K-shaped recovery even worse. What used to be a cycle caused by the free market is now a design by Washington. There's also a behavioral side to this story. During volatile times, people don't lose money because they lack information. They lose money because of their inability to determine what matters most. The bottom 80% get hit by a truck of worry and doubt. This leads to them making poor decisions to correct their financial situation. Markets often reward discipline, not emotion, but the modern financial ecosystem feeds on emotion. Apps buzzing every second, free trades that just cost you attention. The top of the K has algorithms to trade in milliseconds. The bottom has impulses and vibes. In a policy-driven market, clarity beats panic every single time. This is why the media is so focused on gaslighting the public with sensational or misleading headlines.
Won't that cause a recession? If they're really bearish and say rates will stay higher for longer, then they're asked immediately, how deep will the recession be? And that is the litany. It's what keeps people out of this market, causing them to miss out on some moves and the upside.
The K-shaped recovery isn't temporary. It's becoming the blueprint of modern policy itself, what some call the two-sided economy. On one track, capital markets, liquidity, and innovation driven by policy support. On the other, households absorbing the cost through their higher prices and weaker purchasing power. For investors, it means rallies can coexist with recessions. For workers, it means that even when you're employed, you still might fall behind if you're not playing the game like the top 20%. So the real question is, how long can a nation run on two economies before the nation collapses? History suggests that there's always a rebalancing, likely through mass protests. The longer the split persists, the more violent the collapse becomes. The 1970s taught us what happens when inflation spins out of control. The 2020s are teaching us what happens when it never goes away and deflates. We live in a system that borrows against the future to stabilize the present, and we call that prosperity. The K-shaped recovery is a story of a trade-off, a country where the economy and capital wins as its people get stomped into the ground. But understanding it is the first step toward protecting yourself. Because in this new era, the most valuable asset isn't cash, it isn't gold, it isn't Bitcoin, it's clarity. And clarity starts with understanding the macro layout. So invest wisely. But once again, it's been your boy A. Cole. Hopefully you get it, you got it, you're good, you learned something, and I'll talk to you in the next one.